very honored to have David Papell speak to us today about a topic which is near and dear to many of our hearts. It's called Policy Rule Evaluation for the Fed's Strategy Review, and it goes into depth, more depth than you would like. I would like. With Sebin, Nidhiri,
Swati, Singh.
Swati, Singh. And David Papell will lead us discussion right here at this table. So we're welcome back.
Thank you so much. It's great. It's great to be
here.
Back, and actually with the summer conference, I get to come to Stanford like 3 times in a year, which is supposed to once, which is awesome. So
people listening to.
Yeah, I know.
Hi.
Yeah. Why not? Because I'm usually up there instead of here. And so Sebin and Swati are 4th-year PhD students at Houston who will answer all of your technical questions about the Lindbergh or Fergus models. So Reserve, as everybody knows, has started a strategy review, its second strategy review. This was discussed at the January 2025 recent FOMC meeting. There's something in it in the February 2025 monetary policy report. There were press releases earlier speeches by Chair Powell, and I think the first was actually at Stanford GSB, where he mentioned it, and that the new thing from the FOMC meeting is that it's scheduled to be completed in late summer 2025, where earlier they were talking about end of 2025, which of course he didn't say. I'm assuming will be announced at the Jackson Hole conference. Now, the history of this is that the first statement of longer run goals in monetary policy strategy in January 2012 had made the 2% inflation target official and mitigated deviations of inflation from its longer run goal, employment from maximum employment. Oh, let me stop. I'm happy to take questions at any time. I don't need to wait for 45 minutes. So the revised statement on long run goals in monetary policy strategy, August 2020, had the famous or infamous flexible average inflation targeting, or FATE, where the quote is well known. One important thing with this is that it left persistently below, likely aim, moderately above, and sometime undefined. Defined. And the other half is the shortfalls, mitigating shortfalls rather than deviations of employment from its maximum level. If you take maximum level as equivalent to natural rate of unemployment, which is how Rich Clarida would describe it, it means that it reflects the flat Phillips curve. They'll no longer raise the federal funds rate if unemployment is less than U star. So the strategy review was very heavily influenced by the experience during and mostly really following the Great Recession, between 2009 and 2019. And you had the first half with the effective lower bound, and then the second half with inflation or the whole time with inflation under 2%, to the extent that John Williams made a very famous comment near the end of this, that low inflation is our problem. now, which
believe it or not,
didn't quite work. But
watch out what you wish for. You might get it.
What?
Watch out what you wish for.
True. And so, but And I think it's also worth saying that even though the review was released in August 2020, it was completed by the end of December 2019, and if it wasn't for COVID, would have been released early in 2020. So it did not reflect COVID in the slightest. It was very much the decade before. And the same time that the Jackson Hole Conference and Chair Powell's speech and was released, the Fed released a bunch, 8 maybe, of papers that had been prepared for the strategy review and the one that's most relevant for purposes is one by Jonas Arias et al. And these were all mixed between people from the board, people from regional feds. They were very high profile internal papers. And that paper in particular focused entirely on policy rules and on alternative policy rules. And they focused on 2 things. One is average or asymmetric average inflation targeting, where you target the average inflation for whatever number of years before. They used 8, and the asymmetric is that you do that if inflation's below 2%, but you don't do that going down. And the idea is you're trying to stimulate the economy when inflation is below 2% more than a traditional Taylor bounds approach rules, and that they also make up strategies for federal funds rate. One second, federal funds rate, which are make up strategies, and these make up strategies focused on the same idea except length of time at the effective lower bound. Okay, John.
So this whole question of promises about the future are going to stimulate today. There's 2 distinct categories of model behind this. One is the traditional adaptive expectations, old Keynesian view, which is basically just we're going to talk down the long end of the yield curve. Essentially, we're promising lower interest rates out in the future. That'll talk down long yields today. Long yields go down. That helps. The other is, I'll call it new Keynesian magic about equilibrium selection by promises out in the future. And the farther out you make the promise, the more effective it is today. And I'm sure you're familiar. To what extent are these Fed internal studies taking one versus the other view? Did the Fed even talk about how do we think this works? How much of it was infected by, well, Mike Woodford's famous Jackson Hole speech, which was entirely this new Keynesian magic?
I think for the Fed strategy review, as opposed to the whole corpus of Fed stuff, right?
For the Fed, right?
It's for that, or speeches, things like that associated at the time. The real focus is on these policy rules, and I don't think there really was much discussion of which old Keynesian or new Keynesian model.
Why did they say that this was going to work to stimulate today?
I'm going to tell you that in a minute.
All right.
So maybe 2 minutes now. The principles for the 2019 review, these are articulated by Rich Clarida in 2022, but basically starting from basically September 2000 from 2020 in a series of speeches, at least one here. And one principle is asymmetric, that you want to raise inflation moderately above whatever that is, 2% from below, but you don't want to lower inflation below 2% from above. Second is time consistent. And time consistent is why, at least in my mind, the Fed did not adopt average inflation or asymmetric average inflation or make up make up rules, and he famously described fate, in fact, here I believe, as ex ante inconsistent and ex post consistent. And let's not talk about it. that we can leave that one aside. So, but let's go to now, 2025 strategy review. So in 2019, at least it's reasonable to assume that the next 5 or 10 years would be like the previous 5 or 10 years. That it never works. But it's the best, sort of like a unit route. The best you can do is the current situation. So, but what do we have now? Cycles of pandemic, recovery, inflation, disinflation, which hopefully won't be repeated, and not a good basis for the review. And quickly, the experience following the COVID-19 recession, fate was completely irrelevant. Inflation went up, annualized core PCE inflation went up from 1.7% in March 2021 to 3.4% in June 2021. And even this is a paper that Ruxandra and I have that hasn't really seen the light of day yet. If you just do a fate rule, it doesn't even help you then, because the fate pushes you from further below the effective lower bound to a little closer to the effective lower bound, but still negative. Shortfalls, unemployment wasn't above 4% till March of 2022 and just played no role there. So
It's 4.0 now. So.
yes, that's 4.0 now.
Exactly.
Exactly. Yes. It's really not over. Yes. And so I think everybody, including myself, interprets statements by Chair Powell in the light of what they would like to see the Fed do. So I think so, but one is here is that we're not going to, Fed's not going to stay with the 2019, but the Fed is concerned with of having the effective lower bound hitting more often than in the pre-2008 past, and that part of it is the perceived fall in our star, which in the SEP has gone from 2 to 0.5 and now back up to 1 to 1, but one is still smaller than 2.
With the inflation vote in 2021, did the Fed say, well, this is what we wanted? We wanted inflation to creep up above 2 or 3% and look at fate. I mean, that's exactly what we promised. When they never. What's the reason? Why did they never say, have a victory lap and say, look, now we have higher inflation compensating for lower inflation as before, just as promised?
Now, my interpretation of that is that, and again, I will take this from numbers which Clarida gave in this paper Ruxandra and I published last fall on my interpretation is that moderately above was much closer to 2, say 2.5, say not 3.5, 4, and certainly not 9. So that they basically didn't have a chance to take a victory lap because they went from 1.7 to 3.5. So there was no opportunity.
They were still saying, well, our forecasts say it'll go down to 2.5, so we're still within fate.
The what?
Well, they were in some sense, even when inflation was well above 2, they were saying, well, our forecasts say this is all transitory and it'll go away.
The Fed
so even under fate,
in June of 2021, when it went from the 1.7, the FOMC forecast for the end of the year was 3. So that's still not 2.5. And I think the more ambiguous part is, do we go back to 2012? Going back to 2012 there, which he sort of hinted in the last press conference, that would violate the idea of being more worried about the effective lower bound. And in our case, since we're evaluating these things rather than in some sense advocating, we're sort of sidestepping some of this. Okay.
Before you get into timing consistency, John Steinson had a good observation in our last monetary policy conference. I mean, he said, I read Fate, but I always read that there was an implicit footnote saying, by the way, if inflation gets really out of hand, we're gonna raise rates, and being surprised that that footnote wasn't there. I would think with the big sort of structural uncertainties ahead, are we going to go back to the 1970s? Are we going to be Argentina? Are we back to the zero bound? There would be some sort of, here's how we're going to react to events, not just, oh, we're going to readjust the coefficients on the fixed rule.
In terms of coefficients, the Fed never adopted a Fate rule, right? In the 2021 monetary policy report, they have an algebraic shortfalls rule,
no, but
not a Fate rule, for good reason.
We're going to adjust the adjectives. So instead of saying we're going to take the Fate rule and say, instead of moderately, we're going to say, well, substantially. I mean, but instead, there's these big unknowns. We might be back to zero bound in QE. We might be into fighting Argentina. We have contingency plans.
Your guess is as good as mine. My guess is that they're not going to be that specific. And they're not going, and they're certainly, the other guess is they're not going to adopt the rule. So they're not going to say here's
with adjectives. Okay.
They're not going to say, and I'm not going to predict the adjectives. What we're going to do here is sort of talk about rules to try to satisfy some of these things, but the Nidean uncertainty is not something that our rules are going to help us with. So I want to talk a little bit about time and consistency. So if we start with time and consistent policies, Kidlin Prescott, Cap 77, Calvo 78, it's an optimal control exercise. And we all know this incentives for future governments to modify policies that are optimal from today's perspective. This is understood by rational agents, and you can improve with policy rules. And if you want to go back to how you can do this and whether it's possible or not, I suggest reading Guillermo Calvo's 78 Econometrica and John Taylor's 79 Econometrica for very diametrically opposed views of how the Fed could do that. You were more optimistic. The Fed, Guillermo, was more pessimistic. And I think your offices were on the same, or the different floors, but very close.
Columbia.
But at Columbia, yes. And the policy rules that were assumed to be time consistent. This is not what the Fed background papers mean by time and consistency. They mean time and consistent rules. And so if we're looking at these rules, average or average inflation targeting rules, the T average, exactly what John just said. I really don't need to average to talk more about that. You're going from below 2%, you get the above 2%, the average thing says, or asymmetric average, I keep on calling it asymptotic average. Asymmetric average tells you should stimulate the economy even though inflation's above 2%. That's not what you want to do. Nobody's going to believe you. That's the rule story. And they do talk. It's not like these people writing these background papers didn't know about time and consistency. They do talk about this, but in the two papers that just focus on the one, what did they talk about? They talked about the solutions for time inconsistent policies, reputation, Baron Gordon, patent law, in John's too, the sort of general belief of the importance the Fed would solve this in your 79. paper, but these are all applicable to time and consistent policies, not time and consistent rules. So we do not, so we are not going to analyze time inconsistent policies. Time inconsistent rules in this paper. And if you do, yeah, just like you had in 2019, you can do better. That if you really believe, if you believe them, there just isn't any reason to believe that. Okay, so principles for you. Okay, so your reviews, your rules can be symmetric or asymmetric. Symmetric would mean equally stimulative when inflation's under 2%, then restrictive when inflation's above 2%. Traditional Taylor and balanced approach rules satisfy this. The 2012 statement satisfies this. Asymmetric, more stimulative when inflation's below 2%, then restrictive when inflation is above 2%. And I will show you two proposed rules that, in mind, satisfies the asymmetric, satisfies the focus on the effective lower bound, but are time consistent. And that's sort of, that's really the if you want to ask, what is your one takeaway from the paper? Is that's what we do. So there's no incentive to renege when you get above 2%. So this interpretation, I'll call it similar, but it's not identical to Reg Claridge's. Okay, so like the paper, we analyze Taylor type policy rules with sort of the structure of the inflation gap and the output gap, but not all the other stuff that people about. Taylor balanced approach. We'll also talk about shortfall policy rules since February 2021. Mike Kiley has a recent paper that analyzes the shortfalls rules and finds that they don't work particularly well. We're going to basically find the same things. I'm not going to emphasize that too much. And we have two proposed rules: the asymmetric coefficient inflation targeting rule, or ACIT, and the asymmetric target inflation targeting rule, or ATIT. And so what do? We used the linearized version, or LINVER, of the FURBIS model. FURBIS model is the main policy model. It's the model that the Fed staff uses in each Hill book to do their calculations and simulations and simulations. This has been available. I think it started like 96. It's been available since, I think, like 2014 or something, publicly available. Now, LINVER, apparently, though I knew this, has existed about as long as FURBIS has, but they made no mention of this until 2022, where they released a working paper by David Weisschneider and Flint Braden, and basically documentation and code and how you could use this. The big advantage of LINVER is that as long as you it's linear or slightly nonlinear, it takes way less time to run. The simulations, we will show you, each of them take about 30 minutes on a run-of-the-mill PC. FURBIS is like a whole different world. And ex post, we've learned that lots of papers evaluating policy rules that said they were FURBIS were actually LINVER, going back to Weisschneider and Williams papers by Bernanke, Kiley, and Roberts. All of these papers used LINVER. They said FURBIS because LINVER wasn't available. So what do? We evaluate rules by quadratic loss functions, a whole lot of different ones, inflation gaps, output gaps with and without change in the federal funds rate. Sorry, it should be symmetric and shortfalls, not symmetric and asymmetric. I'm trying not to use asymmetric to mean two different things in the paper. So symmetric and shortfalls, and on expectations that that we have for the expectations, financial market participants and wage and price setters have model consistent expectations. Other agents have, or rational expectations, other agents have VAR or adaptive expectations. She'll be first, but give me a second. And basically, you've a bunch of choices here. You could have all agents having model consistent expectations. You could have just financial market participants, but the others not. You give choices. It's what we do is it's robust to any of these, and we don't talk about it in the paper, except for having all agents having VAR expectations. And I think thinking that financial market participants, or even now wage and price setters, have adaptive expectations goes against about 50 years of macroeconomics. So what you first.
I just wanted to ask if anybody is considering deviation in the sense of actually having the price level or price level path in there. And an argument I made at Brookings last fall is that what we're seeing is that in an economy where they were at or below the 2% inflation target for a long time, many, many contracts are not indexed, even long-term contracts. And therefore, that price path can really matter. And we're seeing all these other costs of inflation that we haven't put in our model, like Erik Hurst's paper. And I certainly saw it being on the University of California Task Force for Investment and Retirement, because that generous pension, it turns out, fully indexes up to 2% and nothing between 2 and 4%. And they never tell their employees the effects of compound inflation. So it struck me, given that people in this kind of economy actually care about the price level as well. It seems like they should be targeting the price path. It could have a slope of 2% kind of thing, and that you just try to keep it there. Otherwise, we have this hysteresis where this transitory inflation, consumers suddenly realize, oh my goodness, transitory inflation means permanent price changes, and that can have effects on a lot of people.
I think my answer is that I'm not saying it's not an interesting thing to do or to think about or write papers about. It's not what we've done. There are lots of stuff we have done. One thing, by the way, should have mentioned with the Lindver model, there's no reason to think these results are going to hold across other models. No reason whatsoever. And in fact, one very specific thing between Taylor and balanced approach rules. In fact, it talked about when we talked about your paper with Volker Wieland and back in 2009, is that you get different results with lower loss with balanced approach than Taylor rules for the Furbus model, but not for the Smets-and-Bowder or Klestiano-Eichenbaum and Evans model. So I'm just the defense I'm going to give for this is that we wrote the title for a reason, and evaluation for the Fed strategy review, the main part of what the Fed does have, they do have the SGE models and things, but in terms of the policy part, no reason to believe that the main focus isn't going to be on the Furbus or the Lindver model as opposed to other models. But I came no claim for.
But if I may follow up, I mean, price path targeting seems to be the logical solution. If you have undershooting of inflation for a while, how do you formulate the overshooting? How long should it last? If you have a price path in mind and some kind of rule how fast you get to that, that's a nice time consistent policy that could be formulated. I wonder why the Fed never went that route. Do you know? I mean,
I have, or nominal GDP target,
Nominal GDP targeting would be another one.
is another one. And I guess what I will say is that the Linver model, the FERP model, is very constrained on what you can do. And we've pushed the boundaries of the constraint beyond what anyone at the Fed has done, but we've run up against other boundaries on it. And I have no idea, and Sebin or Swati could probably answer that question better than me, whether anything that would even be feasible in the context of that model.
But let me also push, because this is also important in Europe too. Another way of phrasing it is, do we measure our 2% inflation target as entirely forward-looking with bygones or bygones, or do we say over a period of 5 years, we want to average 2% inflation, which means if you're above 2%, you got to have some below 2%. That's another even easier way. You don't have to say price level target and people go nuts. You just have to, how do we interpret 2% average inflation
If
target?
you use that rule, then you're going to be below 2% for 2 years, and then you have to go. I mean, that would
that's just,
indicate a
it's
cycle,
another,
so.
and the reason I think
I'm going to stop.
the reason
And
this
I'm
is
going to say
important.
this is a really interesting
But you can do
discussion,
that.
but I'm never going to get to my results if we spend the entire
I
time.
do have an actual
Of
orthogonal
course.
question. This is actually a question. Is the model you're using new Keynesian or old Keynesian? By which I mean,
Okay,
does
I'm
it
sorry.
have
You actually asked me that before, and I.
Blanchard-Kahn stability conditions?
okay,
Is the Taylor rule giving you
the-
determinacy or stability?
Okay, it has the Phillips curve has these forward-looking aspects and backward-looking aspects. So from my looking at it, I really don't know whether you're talking about determinacy or stability there, because there's all this stuff
Well, we can find out. This is easy.
in there. Well,
Set an interest rate peg. What happens? Does the model have multiple solutions? Does it say I can't solve with this because it violates
Okay, so
Blanchard
what-
conditions, or
yeah.
is it stable and comes back?
Yeah, I'm not sure that's within the context of the model. So if you want to say just the Phillips curve, okay, whether it's an old Keynes, I mean, it's a mix of the two.
No, this is a property of the entire model. So what are the eigenvalues of the
I
model?
would be very doubtful that you could actually ask that question within the context of the model. It's an interesting question, but as I said, there's a lot of things you cannot. There's very little that you can do within them.
You can set Taylor rule coefficients to 0 and see what happens.
What?
So if the Taylor rule, if it's I equals, peg, you can do that. What happens? Because this is really crucial to what are we telling the Fed, that you have to select multiple equilibria correctly, or are we telling the Fed you got to bring inflation back faster?
I need to think about that. I'm not sure. I'm not sure. Yeah, let me just leave it as
Okay.
that. It's an interesting thing to think about, but and leave it there.
But I asked Ben Bernanke this question and he didn't know.
Well, then I could be in good company.
Send for question.
So, traditional policy rules. Okay, you all know what a non-inertial Taylor rule is. R is the nominal federal funds rate. Lowercase r star is the neutral real interest rate. Inflation, pi star is always going to be 2, and the y is the output gap, right? So that's a traditional Taylor.
Does Linver have a constant R star?
Yeah, Linver has a constant R star, which you set. We will set it at we set it here as 0.9 to
Because my sense is that, R star has been drifting over time, drifted way down, it may have come back. And I think that's one of the reasons that the Fed doesn't like models. They like models for, well, this is what the model would be, but in the real world, R star is actually different. So we're going to shade ourselves down from, gives them reasons to play around. And if you're evaluating, something that's not consistent with the real world, you're only finding good results for a model. You're not finding good results for, the way the world actually works. And so,
And
so
we're saying at any this in time would type, and this is as the effect of lower bound binds, the R star influences how often the effect of lower bound binds in the model. And so
the optimal policy could be very different in a world where R star is fluctuating. So you could, you could do these types of simulations, putting in some, drifts in R star, see how that affects.
Absolutely. Again, I'm going back on my fallback position of evaluating rules for the Fed strategy review. What's the R star? The R star is whatever it is currently. So if we were writing this paper today, instead of the last version a month ago, 2 months ago, we would have 1 instead of 0.9. That's not going to make a lot of difference.
And let's think about U star. U star is substantial movement.
Exactly.
Yeah. Now, remember, answer to that is that we're looking at policy rules with Y instead of with U, although we're going to look at loss functions. But we are going to look at loss functions with U, and that's actually internal to the model.
Well, you can map U star into U star.
If you know what Okun's law coefficient is.
Well, of course.
And since I think I've read everything you've ever written about Okun's law coefficient, we know that's changed also, but maybe not recently.
There's an important rules of the game that you're setting here, which encompasses all of these. You're not allowing the Fed to respond to shocks.
Right.
Because in any new Keynesian model, the optimal policy rule responds to shocks and sets inflation exactly equal to target every period. So you're not asking what's the optimal policy rule in Linver, which you could ask.
Okay.
And you're really importantly saying, and by the way, you're not allowed to respond to shocks.
But here,
It's supposed to work.
No, you have a fixed policy rule and you're simulating based on shocks, and I'm going to move forward. So the inertial, because I think I was told that I should stop talking and ask for questions at 1 o'clock. So I may cut questions. I think I'll cut your questions off now. No. So you could have inertial Taylor rule where you get part of the way. The standard one is the 0.85 and the and 0.15. You can have a non-inertial balanced approach rule where you double the coefficient on the output gap, and inertial balanced approach rule. Shortfalls rules, we take a non-inertial shortfall rule. On the inflation side, it's the same as the Taylor rule. On the output gap side, it says that if GDP is below potential GDP or unemployment is above U star, then you do what you did before and you stimulate it. But if unemployment's below U star or GDP is above, you don't raise the interest rate for that reason.
What do you do about the zero bound when the rule hits the zero bound?
We'll have results that where you can't go below the effective lower bound, and that's all really what I'm going to talk about today. With results where you can go below the effective lower bound. If you can go below the effective lower bound, you can interpret this as, since you only do it with quantitative easing, then think of that as a sort of a shadow, as a sort of a shadow rate for that. And I'm going to say, I'll present no numbers with that. It's all in the paper. I'll say one thing about it later. Then you have the other types of rules. Okay, so what do? We have one, as we call the asymmetric coefficient inflation targeting. The idea of the asymmetric coefficient targeting is that on the top line there, if inflation is greater than 2, okay, then you follow the Taylor rule or the balanced approach rule or whatever version of that. If inflation is less than 2, then you raise the coefficient on the inflation gap. The inflation gap is negative. You raise the coefficient, you stimulate more. So the key here is that you're stimulating the economy more when inflation is less than 2%. But as soon as inflation exceeds 2%, you stop doing that and you flip to the Taylor rule. And that's why this is time consistent, because you are not stimulating the economy more than stimulating the economy when inflation is above 2%. There's no moderately above, and that's why it's because you can say you're going to do this, and then you can do this, and this you're not reneging on anything. We do 3 coefficients, 1, 1.5, and 2. For that, obviously, you want something. It has to be bigger than 0.5. It's arbitrary. I'll talk a little bit about what happens when you get high. Asymmetric target inflation targeting. Remember, the first thing that the Fed announced with the 2019, and the first thing they announced now is they are not raising the inflation target above 2%. What we're talking about here is that if inflation is above 2%, you have the traditional target. If inflation is below 2%, then you have a bigger target. You have a bigger target because that gives you a more negative thing. Then for the same 0.5 coefficient, you have more stimulative policy.
So
And
that
we,
would imply a jump in RT just as you cross pi star, right? I mean, that, I guess that rule is.
but because the gap is minuscule, it's not, there's no jump.
No, if you cross from above pi star to just below pi star, I mean, this is not a continuous function pi t.
Yeah, but if you go from 2.0 to 1.99, you can multiply it by a bigger number. It's not, you're not going to get a discernible gap.
No, I mean, imagine the pi cap t, I mean, just for the sake of the argument, is 1,000, right? Then you would suddenly go from RT, at pi star exactly where you want to be. And then if pi t is 1.99, out of a sudden, you're going to lower interest rates dramatically.
Yes. And that goes back to the argument of not in this context at all, that there's a preference for very large coefficients, even in the Taylor rule type of thing, infinite coefficient, because if you have an infinite coefficient, you never violate it. That's why these loss functions were developed that have the change in the federal funds rate is to penalize having these really big coefficients. In this case, when you respect the effective lower bound, it doesn't make much difference because you're talking about small things under there. But in the version of the model where you can be under the effective lower bound, then it does matter. And there is actually something in the paper could show, Brian, we're not going there, but yes, that's the.
It was more a technical question whether we should be concerned about the policy rule.
Yeah. But it says
continuous in inflation, but
yes. Okay, and so we do 2.53 and 3.5. Again, you can do different numbers, actually. But again, I'm fairly sure if we had infinity, then you would not do very well with the law. Well, with the loss function, when you don't impose the effective lower bound and you don't have the penalty. We're not in that territory today. Okay, loss functions. Okay, we have symmetric loss functions. Loss function being the difference between inflation and target squared plus the output gap squared. And you could have, which we call symmetric with the change in the federal funds rate. We stick in the change in the federal funds rate squared. That turns out to be not matter. I'm not going to talk about that at all today. Shortfalls that if if output is under Y star, GP is under Y star, then you have the normal loss function. If output is greater than Y star, you wipe out that output gap part of it. That has the effect of having all of these shortfall loss functions giving you smaller loss than the symmetric ones, which is utterly irrelevant because you're just wiping out that part of it.
Here you could do PT minus P star if you wanted to. Or you could do sum of pi t minus pi star over 5 years squared. I think we're all saying this would be interesting. I mean,
yeah,
the
no,
peasants
I'm
with
saying,
pitchforks were
I'm
mad
saying
about
one,
the price
it,
level.
one, it could be interesting whether it could be done in the constraints of the Linver model is something I don't know, but it's an interesting question to pursue, but I'm not going to talk about P today in my next 12
But
minutes.
it's just a suggestion because
Yeah.
even at the Fed, they understand that people are mad about the price level.
Yeah.
So they are going to be thinking about this.
Well, just look at the last election. Oh no. So yeah, yeah. So I said, I'm with you. I just don't know in this context if it could be done or not. That doesn't mean that we or somebody else do it in a different context who might be better suited to do it this. But let's just hold off on that. I am now laying down the law. I'm not going to answer anything that has P in it then. Okay. Shortfalls, and you can have it with the change. You can, and we also substitute the unemployment gap in the loss functions for the output gap. Okay, so we have 8 types of rules. We have 4 versions of each rules. We have 8 loss functions. We have policy rules with and without. The effective lower bound. I think once we put in the with and without, I think we're up to 512 in the paper. Okay, I'm not going to show you 512. So here's what I'm going to show you. We're going to look at symmetric loss. I'm going to do one thing with shortfalls, but symmetric loss without the change in the federal funds rate. Putting that in is irrelevant. So the first thing is we look at things. We look at the Taylor rule, the balanced approach rule. We look at non-inertial rules, inertial rules. And 2 takeaways from here. One takeaway is that there are big differences between Taylor and balanced approach. Taylor, the losses with balanced approach rules are sort of smaller than the loss with Taylor rules. Which is why I think you should have just said, oh, that's just a form of the Taylor rule in 2009 and gotten all the credit for it, rather than just call it the Taylor 1999 rule rather than the balanced approach rule. Which, by the way, in the Fed stuff, most of the time when they refer to Taylor rules, they're actually referring to balanced approach rules. They sort of cut that. But the other part is inertial and non-inertial is very small differences here. Okay. Now traditional and shortfalls. So now we're going to look at balanced approach inertial only because they were a little small, slightly smaller than the balanced approach. Non-inertial doesn't make any difference. They're output gaps, and now we're going to look with symmetric loss and shortfall loss. So basically everything is going to be almost as there was in right. So let's look at 2 things with traditional rules and shortfalls rules, and with symmetric loss. There's a huge difference between the traditional rules and shortfall rules. The shortfall rules are a disaster on this, and this is something Mike Kiley said in his 2024 paper. This is not original for us. But what happens when you do shortfalls loss? Well, the traditional rules still do better, but the gap is way smaller.
Maybe you're missing something here. It says these are output gaps, but you're not optimizing giving the loss function, right? So I thought the rules are fixed in a fixed coefficients, and they would imply the same output.
We use the Lindver model, there's a Y star internal to the Lindver model potential output. And so you get the output gap from.
So you get the output, I understand you get the output gap. So if you put in a particular policy rule, you get a particular average output gap, but the loss function doesn't matter for getting the calculation for that output gap.
The loss function.
But here it says something about loss function. Are these the losses or are these the output gaps?
So these are the losses.
These are the losses.
No, I'm sorry. The numbers are all, sorry, I misinterpreted what you said. The numbers are all losses.
I see.
And they are losses, they are losses.
You were just thrown off by the title output gap width.
Yeah,
You're using the output gap in the loss function.
we're using the output gap in the loss function
Okay,
with
makes sense.
balanced
Okay.
approach.
No, I-
And by the way, we have same things with the unemployment gap instead of the output
right,
gap,
yeah,
and
yeah.
nothing
Just
changes.
semantics. Yeah,
Nothing
thanks.
changes. I said, basically, this is like, 6 pages of tables, just with picking out a few to show you. Okay. Okay. Now, what about the AC and CIT policy rule evaluation? So the first thing is we're taking the inflation gap coefficient of 1.5 to show here, and again, the coefficient itself, these choice of coefficients is arbitrary, right? We're doing a range of coefficients. You could do other coefficients, but the point from this slide is again, very similar to the traditional rules. Bounce approach does much better than Taylor rules, and that non-inertial and inertial are tiny.
David, what's happening to long rates in these models with non-inertial rules? Presumably, they're much more volatile, and that's going to mean much more risk in the banking system. That my understanding was that the whole emphasis on inertial rules is designed to protect the banking system, that to provide them a path, that they can manage their longer term assets and then engage in maturity transformation.
See, I don't think any of that enters this model.
No, nothing, that doesn't enter, but
My interpretation of the inertial rules comes from the Fed wanting to smooth out.
Right. Why do they want to smooth? They want to smooth because the banking system gets in trouble when interest rates are highly variable.
But I
part
think,
of their mission
I think
is
wanting to smooth can be, beyond, like, for example, Glenn Rudebush has a 96 paper on ways of interpreting smoothing, and I don't think the word banking system appears. So I think the point could be more general. I'm not saying that it's not important with the bank system. I think the point could be more general than the banking system. Okay. So now let's look here at the differences between the traditional rules and the ACIT rule. Remember, the traditional rule has a coefficient of 0.5 on the inflation gap. I have 3 rules with the ACIT with 1, 1.5, and 2. So of course, the traditional rule is the same loss, whatever you have with this. And again, it's the same output gap symmetric, whatever. And that the losses, the losses with the ACIT rules are uniformly under the losses with the traditional rules. They're moderate. They're not as big as the losses with Taylor and balanced approach. They're bigger than inertial, non-inertial. As the coefficient goes up, the difference increases at a decreasing rate. So you think that as you go, hopefully you'd reach some sort of, you're not, these differences are going up, but they're not they're not going to become infinite, although this is as far as we've gone. Okay. The IT rules, again, this is again with an inflation target. Again, inflation, the asymmetric, the inflation target, not the inflation target of 3. Taylor bounce approach, again, what we've seen before, big differences there, small differences, inertial and non-inertial. Again, I think more interestingly is the traditional and IT policy rules with the different coefficients, again, smaller with the IT rule than the traditional balanced approach rule. Moderate differences increase as you increase the inflation target when you're under 2%, but increase at a decreasing rate when you do that for the same increments there. One thing we do, this is the only thing, yes, go ahead.
Since you're moving on to,
Yes, what? Go ahead, yes.
why
This
is
is
it
fine.
not interesting to ask the optimal rule? So given a loss function, given a model, what's the optimal rule rather than I'm going to just try a bunch of different rules at it?
As I said, I'm going to put that in the category of something that it might be interesting for somebody who finds that a more interesting question than I do to work on.
Why didn't you find it an interesting question?
Because I think that first of all, optimal. If you go back to time inconsistency, all rules are suboptimal. So now you want to be talking about the optimal suboptimal rule. And I said, I think that's a question that you could address, and people haven't addressed in smaller models. I don't. I think that's again. I keep on going back to the to this paper with the words in the title of Fed's strategy review. Now you can expand past that, and there's lots of other things, but
you will have to respond to referees who will ask this question. And I actually think it's an interesting answer that you sort of trust this model well enough to evaluate how given rules work, but you don't trust it to calculate the optimal rule because you think that'll send it off into space somewhere. Yeah, tell the referees that.
I should write that down so that when you referee the paper, I know what the response would be.
I'm going to ask a question on behalf of our audience today, okay? Because we have a lot of people here today, and I'm going to guess what one of their questions might be. They have been schooled to think about the trade-off in terms of rules rather than discretion, okay? And now we're thinking about a rule, and an unsophisticated person might think these are all variations of a very similar rule, and yet they get very different loss functions, very different sort of results and answers. How should they rethink what they have learned about the trade-off of rules rather than discretion?
I mean, I guess I would call that what your audience has learned about rules versus discretion is really the 1970s time inconsistency. And again, for me being a student of both John and Guillermo, it's sort of in my blood there. But this discussion is in terms of different policy rules, and I think here it's really a question of if you have a policy rule where which violates the time inconsistency, then then you just can't even analyze it. And in fact, one sort of coda on that is within the Linver, you really can't analyze it because all model consistent expectations are assumed to be fulfilled. Right. Again. So,
But for those of us who only came into this profession in a post-rational expectations world, I would think they might be surprised how many things that look really similar to a Taylor rule at its face are so incredibly different in all different ways. And what they should take from that, I think, might be helpful.
I think they're not necessarily all that different. I think a lot of them very, except for the Taylor balance approach, that the ones, there are differences there. They're not big. They're moderate, and that seems to be a finding of people who look at those rules. So, I mean, maybe one way of saying saying that, and I'm going to channel my inner John Taylor on this, is that what's actually important is that you have a rule and you follow the rule and you establish that, and the secondary thing is which rule it is. So
You have to finish.
Hence
What?
rules rather than.
I have to finish. Okay.
Well,
So
another, in answer to Laurie's, one feature of all these things is that inflation neither spirals out of control, if it turns out it's an old Keynesian model, nor suffers multiple equilibrium volatility, if it's a new Keynesian model. Otherwise, a lot of the difference also then depends. In an old Keynesian model, it's how quickly you get rid of inflation. In a new Keynesian model, all the details of the rules are an implicit time-varying inflation target, which you hit perfectly, and those are actually quite different.
but again, as you know, the conditions for stability or determinacy are the same. It's the Taylor principle. Right?
Yes.
But in fact, we've had this discussion about sufficient and not, we're not going to go. Okay.
Why the model gives different answers depends very much on whether what the model is doing is giving you determinacy about a time varying point, or is it giving stability? And then the question is, how quickly does it come back? So the intuition that Laurie wants.
And I'll throw it
It's
back
quite
to you, that I believe your conclusion from your 2010 or so JPE paper is that there are all these issues with determinacy, but we shouldn't go back to non-uniqueness. And let me take 1 minute and then open to questions. Okay, what was that fair?
The price level is the
What?
answer.
All right. That was after 2010. Okay. Just really quickly, one example of this. These are of course rules where you're not respecting the effective lower bound, and just you have more stability, more differences with these between the traditional rule. If you look, the biggest things, just look at going down to like the 2011 Q1. That's the most dramatic thing. That there's a pretty big difference in the prescription of these AT&T or ACIT rule than there is with the traditional rule. These are, and this is with the Taylor rule. Balanced approach is a little smaller than that, but we don't need to talk about that. And you've seen the conclusions. I will again say that my takeaway from this is basically you can do moderately better with our proposed rules than with the traditional rules, and not violate time inconsistency the way the average inflation targeting or the make-up rules do. And so I'm now done. So now we can ask as many questions as you want.
A short one, and it's an actual question.
It can be long.
This is a question mark with it. You didn't show much on the persistence and how quickly the rho coefficient, and your wonderful results from last monetary policy conference, where if you have rho equals 1 and have a fully adjusting rule, then things get very different. So what about the optimal persistence? How quickly should you get back to the Taylor rule?
Yeah, and you're right. We're looking at a different.
So these were all persistence zero.
And remember the
right
previous
away.
work that again, this is all model free. Everything that was presented before. I mean, when you're talking about going back to the 2019 monetary.
So just in here, I gather all of your rows were zero.
But rows being,
Row is the coefficient on lagged interest rate. So you
no, no, no,
just.
no, we have inertial and non-inertial. We have 0 and 0.85.
Oh, okay. So quickly, how did inertial versus non-inertial work out?
There's small differences.
How about rho equals 1? What happens?
Those are the only things that we've tried. Those are sort of those are the leading candidates, right? But very little differences.
Question over here.
I guess sort of getting back to Fed strategy review sort of question. So I'm curious what your thoughts are around, I mean, what you think they're going to do. And I mean, my sense of things is the big question is whether they're going to kill faith or not. They're definitely going to keep inflation targeting. I interviewed a Fed governor last week. She said, there's one thing, 2% inflation targeting is one thing we should keep. But to me, I see this really more in the lens of, like, I guess the sort of political, I guess regret aversion sort of minimization challenge, which is that the Fed already has some egg on its face, even if they won't admit it, or most won't admit it, and they haven't even got inflation back to 2% yet. And my sense of things, and correct me if I'm wrong, is that they probably would err on the side of not making changes to the mandate until they get at least inflation back to 2% first. So maybe that would be a reason to keep FATE, even though FATE was sort of something designed for the pre-COVID period. But again, I mean, maybe if they did that, they'd tailor FATE to being more sort of universal than it was sort of before. But I'm curious what you think about this calculus around, do we keep FATE?
The first thing they said is, we are not going to change the 2% target. Or as Rich Clarida said the last time, full stop. I'll say it again. We're not going to change the 2%. And they've said it again. So that's clearly off the table. Now, I would be really, really, really surprised, a little less surprised than the last one, if they said, oh, FATE and shortfalls that we did in 2019 were great, we should keep them. I really don't see that. Now, so I'd also be surprised, but less surprised if little less surprised if they said, oh, let's just go back to 2012. And the reason I'd be less surprised is two reasons. One, it doesn't go along with the worry about the effective lower bound that Jay Powell's emphasized a lot. And the other reason is that they're not going to say, oh, we made a mistake in 2019, we're going to go back and do that. They're not doing that. Okay. So I think what they're going to do is do something that's gonna somehow muddle their way through this. They will not say we're going to have a policy rule, although they're going to. I'd be surprised if they didn't have papers that looked at policy rules. And that, I mean, I gave this paper in early December at the board, and of course my suggestion was that they should at least analyze our two proposed rules, and they didn't all say, oh yes, we're going to do that and make it a focus of the review, but of course they also didn't say no. So of course but what sort of thing they would come up with to replace
So in a lot of Fed speak, there's emphasis on anchoring inflation expectations at the long term, and they get forecasts from the blue chip forecasters. They get the forecast from the TIPS Treasury spread.
they get everything.
Yeah, and so they clearly look at those, and and that goes into the discussions they have at the FOMC. Is pi here, I take it, is actual inflation.
Yes.
What if you put what if you made it expected inflation, model consistent, expected inflation as the driver of R star plus expected inflation?
I think from model consistent inflation would be basically inflation from forecasts from a Phillips curve. And that goes against the flat Phillips curve, other stuff. And in fact, like Rich Clarida, who of course is not there anymore, but he emphasized over and over again their interest looking at this index of common inflation expectations, sort of looking at everything, but the whole, not going to be looking to the forecasts from Phillips curves, and they could be back to that, but that sort of hasn't, I mean, I think the decade between 2000 and 2019 wasn't kind to that internal argument with the Fed, and the argument that we need to be looking at inflation forecasts, not inflation.
Commissioner.
Rates.
So here's something that puzzles me about the numerical results that you showed before, which is you have a linear model, right? So let's say you have a symmetric loss function, then intuition would suggest that a symmetric policy rule would do better than an asymmetric policy rule, right? Because everything is symmetric, so you want to do the same thing on both sides to, minimize the loss, as it were. But you showed results that looked like the asymmetric rules did better. And I'm wondering whether that's about really getting closer to the optimum that John suggested. So let's say really what you ought to do is just being more aggressive on inflation. But now you're comparing two rules, one that is sort of, somewhat soft on inflation, to one that's more aggressive on one side of the inflation. So becoming more aggressive. So it's not the asymmetry that does the trick. It's just really about the rule becoming more aggressive with inflation. And if that intuition is correct, that suggests that maybe the way you want to compare symmetric and asymmetric rules is, if you do a little more on the one side, you should also do a little less on the other side. So on average, you're doing the same. It seems very puzzling to me that the asymmetric policy rules should do better given the symmetry and the linearity of the model involved.
And again, our here is that we're not going to, I mean, yes, we know that bigger inflation, bigger coefficients on inflation will do better until they don't when you put in penalizing changes in the federal funds rate. So what we're got is say, okay, keep that 0.5 when you're above 2%, because again, we could take what we had and say we made it to make it one if it's above in both rules, and then bigger ones under. But the reason that I think these asymmetric rules work somewhat better, not dramatically better, right? But somewhat better is that they push inflation closer to 2% from below, and from below without getting you to the point where you're getting into the.
There's one question over here. We sure.
This might be a bad question, but I'm wondering, for all these coefficients, why don't you just let them float and optimize over one of these loss functions? Why 0.5 or 1.5? Why not just have them be variables and then optimize the loss functions for these things?
Part of it is that goes as we're in the realm of what let's call simple policy rules, where you're saying here's the coefficient, people know what the coefficient is, and that helps with the policy. If you go into these time varying coefficients or optimizing each period, things like that, people just don't have an idea of what the policy is. And I think that's the argument for the simple rules, which of course are not optimal rules.
Thank you, David.
Thank you.